Continuing our series with Rick McCullough and I talking about franchise opportunities available that you can look at through an investor lens, we're going to continue from the last webinar and start to talk a little bit more about the details that you'll find as you're looking at these businesses, the details that you're going to get in that FDD, that franchise disclosure document. Remember, that's 23 items. Lawyers talking to lawyers, about 250 pages. The good news is those 23 items are an outline that will be available to you in every single franchise system. And so helping you understand the terminology and helping you understand the language around that will help you look at this from an investor perspective.
On this next slide, you can see that what you have in there is something called an item 7 and an item 19. Item 7 is the franchisor's best estimate of what it's going to cost you to start the organization up. What they do is they look at how the startup cost has varied from state to state, different size of locations, different metro areas, and what they're disclosing in most cases is kind of a range. And you'll see a range of dollars in total, and then by each major element. So they'll show you what the franchise fee is. They'll show you what cost you might have in the way of equipment. They'll show you what you would need in the way of lease space. They'll make estimates of leasehold improvements. As you go through this document, I think you really need to realize that these are just estimates and they range depending on market size. And you probably want to do some of your own homework on individual components, probably most notably the real estate market. As anybody knows, markets vary quite a bit. Depending on the market conditions, the landlords may work with franchisors more or less depending on market conditions. And so when you look at this schedule, some of the largest numbers you'll see are related to real estate.
So remember, guys, there's going to be a low range to a high range, and that's what's going to be the gap in the bottom of that item 7. You're going to say, is this 150, Lisa, or is this 350? I say, well, I'm in Appleton, Wisconsin, so I'm probably down on that lower range. You're sitting in Dallas, Texas, you're going to be on that higher range. Your rent's just higher, that type of thing. But the other thing to keep in mind there is equipment. And so that's why with the item 7, remember, there's notes at the bottom. Looking at those notes will help you get that gap. A lot of it with around the equipment is the fact, are you going to lease this equipment and have a monthly, you're going to know what that bill is around the lease, or are you going to buy that equipment? And then you have depreciation to think about, of course, investors, and you can determine that. But so when you get the item 7, when Rick says it's an estimate, read the notes. If it's an important business to you, we're going to read the notes. We'll figure out where your investment is. And then we are going to figure out, this goes back to a previous webinar that we did, where your tax opportunities are.
Right. The other element, item 19, which is consistent in all these FDDs, is the disclosure that deals with the profit and loss estimates for the individual franchisees. It varies quite a bit from franchise to franchise. It's in most cases, it's in a high-level summary form. You need to really kind of make sure you understand how it's being presented. You know, is it being presented, for example, on a particular business unit, one territory, or could it be multiple territories? Is the business been in operation for 3 years, or has it been in business for 15 years? There does have to be some interpretation done with these numbers. And this next topic that I'm going to address on this next slide is trying to alert you to some of the challenges in financial modeling. And we already talked about the item 7 and the need to probably consider talking with independent real estate people in your market. The franchisor will typically have real estate people, and they're more generalist. They're not as specific to your market. And so you might want to talk with them to get a good feel for real estate costs. The other thing that I see routinely in item 7 is when it comes to working capital, they will estimate most often about 3 months, maybe 6 months of working capital in their tables.
The federal minimum that they have to disclose out there is 3, but you will see it higher in an item 7. Again, it just goes to reading the notes. This is where it becomes important. The minimum is 3. Everyone has to have at least 3, but sometimes it's 12. I mean, I have a brand that says for working capital, you're going to need, I have it written down, I show the brand a lot, 177 to 280. So that range of working capital is an entire year. That can make a big difference. I mean, I wish they would all put a year in, but
I wish all the franchisors did that, because I think 3 months almost invariably is too little. And the way I would recommend you approach it is, again, look at your own financial models. Put your financial model together, make your assumptions about how fast the business is going to grow, what your labor cost is going to be, and the like, and then probably stress test it. Because if you think about just in general, probably business failures, probably the number one reason is for undercapitalized business. I would highly recommend you look at your own models, stress test them, and then come up with what you think is necessary to adequately fund it to get you through that point to break even. In the item 19, I think some of the difficulties that you may have is, again, trying to figure out if the data that's being shown is for a 5-year-old business or a 10-year-old business. So one of the things that you probably ought to do and think about is, as you go through and you develop your model, as you become more and more familiar with the brand and you're looking at the disclosures, start your list of questions of things that you need to try to tie down. And because there's a whole phase of this process called validation. It really involves the opportunity, which again, I think is quite unique in the investment arena, where you can actually speak to other owners of the business. You get to kind of talk with your counterparts that have already made their decisions, been operating the business. If there's things that you can't determine by the FDD item 19, I would encourage you to talk with the executives of the franchisor and then also specifically with the other owners. The last thing I'd like to cover is principal purpose of this FDD is meeting the franchisor's legal disclosure requirements. When you work through with a franchise attorney, which we highly recommend that you work with an attorney when you get down to final steps in your decision, the thing that you really need to be focused on is the franchise agreement, because that really is the agreement that you'll execute with the franchisor, and it covers how you plan to do business together. It defines how you do business together over the term of the agreement. And just like most agreements that you've seen in business, it's going to favor the party that is the franchisor. I'm not saying you need to be worried about it. You just need to be alert to, well, what happens if things don't turn out exactly the way you planned? It's kind of the bad case scenarios, but with your attorney, you can kind of go through and just understand what happens, what your risks are, and consider how you might need to deal with that from a risk mitigation point of view. Again, the attorneys can be extremely helpful in understanding the components of the business structure and what you're committing to.
Right. And as an investor, the biggest thing to remember is that it's a disclosure in the beginning. It's not a promise. It's a disclosure. They're saying, here's what has happened. Here, this is the rearview mirror. This is not a crystal ball. This is not your projections. This is what has happened, and this is the history. So that's where the item 7 comes from. It's also where the item 19 comes from. And so you're using those disclosure opportunities to lay out your business model, not necessarily taking it as a business plan, because that's not really what it is. It's a disclosure so you can model out your business. And Rick referenced the franchise agreement and having a look at that. The back of your FDD does contain a sample of the franchise agreement. And so you'll be able to have eyes on that. There's, a little bit of common, we'll say, misconception out there that it's absolutely not negotiable. And friend, everything's negotiable.
Kind of a closing thought and a little bit self-serving, but Lisa and I are both franchise consultants, advisors. We're skilled in kind of what's available in the way of information. We're skilled in helping you about how to think about things. We can help you with questions that you may want to develop to talk with the corporate executives and other owners. But when you get right down to it, the whole analysis is really about risk assessment.
Absolutely.
That's your risk assessment. We will do our best to try to put you in touch with the kind of businesses that we think match that tolerance level that you have individually. But in the final analysis, this is something that you will need to spend a good bit of time on and be thorough in your analysis, because there's big rewards, but just like with anything, there's also things, risk. And if you don't spend the time, you could be surprised by that.
Absolutely. All right, that wraps up the FDD. Again, like Rick said, please reach out. We're doing these webinars to definitely stimulate conversation, but also we know that they're going to create questions, and we hope that that we can try to help answer those. So thanks so much.